The last question is P16.1. The equity section of Martino AG at the beginning of the current year appears below. So there's share capital ordinary, share premium ordinary, and retained earnings. During the current year, the following transaction occurred. So we have 6 transactions, and then we need to prepare the journal entries of the current year. So 1 to 6. We go one by one. The first one is the company issued to the shareholders 100,000 rights. 10 rights are needed to buy one share at 32 euro. The rights were void after 30 days, and the market price of the shares at this time was 34 euro per share. So because this is just a share right, there won't be any journal entry, until the shareholders exercise this right. So for the first one, there is no journal entry, just the company will make the memorandum entry when they issue the rights to existing shareholders. And then the second one, the company sold to the public a 200,000 10% bond issue at 104. The company also issued with each 100 bond one detachable share purchase warrant, which provided for the purchase of ordinary shares at 30 euro per share. The net present value of the bonds without the warrants was 192,000 euro. So this is the bonds with the detachable share warrant. So we need to determine first how much is the equity component. Okay, so the fair value of the bonds, it is 104% times 200,000. So the fair value of the bonds altogether is 208,000, and then minus the fair value of the liability component 192,000. So we can get the equity component is 16,000. So the journal entry, very simple, just debit cash, credit bonds payable 192,000, and then debit cash, credit share premium, share warrant 16,000. And then the third one, all but 5,000 of the rights issued in number 1 were exercised in 30 days. So all but 5,000, it means that only 5,000 that of the rights that won't be issued. Okay, so we need to prepare the general journal entry when we issue the shares. So debit cash 304,000. This is from the whole 100,000 share rights minus 5,000 that wasn't used by the shareholders, and then divided by 10. Okay, why do we divide it by 10? Because we need 10 rights to purchase one share. Okay, so that's why we divide by 10, and then times the 32 euro, which is the exercise price. So that is the 304,000, and then credit share capital ordinary 95,000 is from the 9,500 shares that has been issued times the 10 euro par value. Okay, so the par value is from here. Okay, and then credit share premium ordinary 209,000, just the difference between debit and credit. And then number 4, at the end of the year, 80% of the warrants in number 2 had been exercised, and the remaining were outstanding and in good standing. Okay, so the warrant that we have sold to the public in number 2, 80% had been exercised by the shareholders. Okay, so when we exercise the share warrant, of course, we need to eliminate the share premium of the share warrants, according to the percentage. So our share premium share warrant in the beginning is 16,000 because it is exercised 80%. So we need to eliminate the 80%. So 80% of 16,000 is 12,800, and then we will debit cash. So 80% times 200,000 divided by 100. Okay, so this number is from the whole amount of the bonds, and then divided by the 100 euro for each bond. Okay, so 100 euro bond equals to 1 warrant. So that's why we need to use the whole 200,000 divided by 100, then times 80%, and then times the 30 euro as the exercise price. Okay, so the cash that we receive is 48,000, and then we will credit share capital ordinary. So we can just take the amount exercised times 10 euro par value. Okay, so 16,000, and then credit share premium ordinary, just the difference between debit and credit. And then number 5, during the current year, the company granted share options for 10,000 ordinary shares to company executives. Using a fair value option pricing model, the company determines that each option is worth 10 euro. The option price is 30 euro. The options were to expire at year end and were considered compensation for the current year. So the company granted the share options. Yeah, so 10,000 times 10, that will be the compensation expense. And then the expense is only for 1 year because it's expired at the year end. Okay, so you will debit compensation expense, credit share premium share options, 100,000 euro. Okay, and then number 6, all but 1,000 shares related to the share option plan were exercised by year end. The expiration resulted because one of the executives failed to fulfill an obligation related to the employment contract. So from 10,000, only 1,000 that is failed to be exercised. So only 9,000 of the share options that were exercised. Okay, so uh, when we exercise the share options, we will debit cash. Okay, so 9,000, yeah, 9,000 shares times the 30 euro exercise price, so 270,000. And then just like the warrant, we need to eliminate the part of the share premium that has been exercised. So 9,000 that is already exercised divided by the whole 10,000 of the share options times the 100,000 share premium share options from the compensation expense, so 90,000. And then credit share capital ordinary, it is from 9,000 times 10 par value, so 90,000. And then credit share premium ordinary, the difference between debit and credit. And then for the remaining share options, because it is already expired, so we need to reclassify it. Okay, so we reclassify it to decrease the compensation expense. Yeah, because this is because of the service factor, so we can adjust our compensation expense. And then B, prepare the equity section of the statement of financial position at the end of the current year. Assume that the retained earnings at the end of the current year is 750,000. So we just need to remake this part, the equity section. Okay, so write the company name, partial section of the statement of financial position, December 31st, 2000 something. And then the equity section will start with the share capital with the information. Okay, so basically it is just you take the beginning amount and then you plus with the journal entry that we have made so far. So you just add with 95,000, share capital ordinary, 16,000, and then 90,000. So you will get 3,201,000. Okay, and then for the share premium also ordinary, so you start with 600,000 and then you add with the share premium ordinary 209,000, 44,800 and 270,000 to get 1,123,800. And then we have the share premium warrant, okay, that still hasn't been exercised. So 16,000 minus 12,800 equals to 3,200, and then we sum this, okay, to get the total of share premium, and then you add with the retained earnings 750,000 from the question, okay, here. So the total equity is 5,078,000.